Is it just me, or is everybody talking about ETFs? ETFs are one of the most popular investment products of the last decade, and there's a very good reason for that. Over the last 5 years, ETFs have returned on average around 7.4% per annum each year, and in the last year alone they returned 21%. So if you'd invested $5,000 in an average ETF, you'd have made a nice $1,000 return while you were sleeping. And if you'd invested in the top performing ETF of the last 5 years, you'd have made a massive 41% return on your capital each year. ETFs make great investing sense, but for many of us, they're still somewhat of a mystery. So in this video, I'm going to explain what an ETF is, the kinds of ETFs there are out there, how you can invest in them, and how to pick the best one for you. Exchange-traded funds, or ETFs, are investment funds that have been listed on a stock exchange. This means you can trade them as you would ordinary shares. But when you buy shares in a company, say like Apple, you're investing in the stock price of that one company. This is a great way to make money, but it can also be pretty risky if the stock price goes down. When you invest in an ETF, on the other hand, you're buying shares in multiple companies, sometimes hundreds of them at a time. So if shares in Apple go down, you might not lose as much because shares in another company, say like Netflix, could go up. And they fall into 3 main buckets. Most of them track a group of stocks. This is known as an index. These are called index funds. Not all ETFs do this, but most do, and we'll get back to the others in a bit. Australia's most well-known index is the ASX 200, which is a collection of shares of the 200 biggest listed companies in the country. So the price of an ETF that tracks the ASX 200 would rise and fall along with that index. This is called passive investing. Passive meaning the fund managers don't actually have to do much of anything. They just set up the fund and let it go. The second main group of ETFs are known as synthetic ETFs. These don't actually hold any stocks at all, but instead they track the price of an asset, usually a commodity, for example, gold. And finally, there are actively managed ETFs. Actively managed means that there are literally people attempting to assemble what they think will be a winning combination of assets together into a fund, trying to beat the market. Typically they don't, but that's a video for another day. You can use ETFs to invest in just about anything. So say you think that tech companies are going to continue to dominate. Well, there are ETFs for that. And the same goes for ethical stocks, or Australian property, or infrastructure, consumer goods, and even robotics, which is awesome. And you can also invest in regions like Asia, or even specific countries like, say, Japan, or India, or China. And if you care about climate change, there are around 10 ETFs listed on the Australian Securities Exchange that exclude companies directly engaged in fossil fuel production and environmental destruction. Choosing the right ETF for you will come down to your personal circumstances. You'll want to ask yourself, how much money can you afford to invest in the stock market? Can you risk losing any of it? And how long can you have the money locked away for? And generally there are 3 key points to think about when you're perusing your ETFs. Number 1 is risk. ETFs can range from low risk to high risk. Generally, index fund ETFs that invest in a diverse mix of major Australian or global companies are among the safer options, whereas synthetic or actively managed ETFs might carry more risk. Next step, fees. There are 2 main fees to think about. First is the brokerage fee charged every time you buy or sell, and that depends on your broker. And the other is the ETF management fee, which is a percentage of your balance that's charged every year. As a benchmark, the average ETF fee is around 0.5% per annum. Finally, performance. Different funds will perform better over different timeframes. Look at how it has performed over the last month or year, but also check its performance over several years. If the fund is relatively new, you can also just check the performance of the index itself, which typically backtracks for 10 or 20 years. Most Aussies who choose to invest in ETFs do so for the long term. In 2019, the ASX 200 index returned 23%, so a lot of ETFs had similarly high returns. But if the market drops one year, you probably wouldn't see returns that good. And since most ETFs passively track the stock market in various ways, you'd expect that they'd perform similarly, minus the fees. So say you'd invested in an S&P 500 index ETF prior to the stock market crash of 2008. If you'd removed your funds just after, you'd have lost around 50% of your investment. On the other hand, if you could afford to hold on for another 6 or 7 years, you'd be back in the green. Long story short, the longer your investment in an ETF, the safer you tend to be. If you've got any questions about investing in ETFs or anything else, drop me a comment below and let us know if there's anything else you'd like us to make a video on. You can read more about how to invest in ETFs and how to pick the right online broker for you through the links below. Thanks for watching.